Welcome everyone to the first lecture of the financial reporting module. I'm your lecturer for the day, and this first lecture is about the conceptual framework, rather an introduction to what we shall see in what remains or what this module is made about. Well, it's basically misunderstood that this module is made up of mostly of consolidation of accounts, but that's not really true. Consolidation is just a part of the entire module. And today we shall see an introduction of the entire framework that makes up how we shall prepare our financial statements and ultimately how we shall be consolidating our financial statements. So, let's start with a very basic question. We all know how to prepare financial statements. But let us consider now, why should we even prepare financial statements? Why should we take this pain altogether of preparing financial statements, of finalizing them, of publishing them for users? Why should we take the pain of doing all this hard work? Well, so why are financial statements produced worldwide? The answer is to satisfy the requirements of external users, because the financial statements are used by these external users to make economic decisions. Of course, each user has his own information need, which we shall see in a few minutes. So now we know why we should be preparing financial statements. Now, it is said that financial statements can be prepared under two methods, under two bases. First, we have the cash basis. The cash basis means that we record transactions as and when we receive money or we pay money for these transactions. For example, we'll record a sale of goods only when we have received money from that sale, or we shall record purchases of goods for resale only when we have paid money to acquire those goods. Credit transactions are not considered here. That's the cash basis of accounting. And secondly, we have the accruals basis of accounting. Now, what does the accrual basis mean? The effects of transactions and other events are recognized when they occur, and not as cash or its equivalent is received or paid. And they are recorded in the accounting records and reported in the financial statements of the periods to which they relate. In other words, under the accruals basis, whether or not we have received cash or we have paid cash for the transaction, we'll record the transaction as soon as it occurs. In other words, revenue is recorded as soon as it is earned, and expenses are recorded as soon as they are incurred. So the accruals basis is a very important part, a very important starting point, I would say. And all the financial statements produce the syllabus. We shall be using the accruals basis of accounting. We don't use the cash basis of accounting. We shall be using the accruals basis. Now, we just said that we record transactions as soon as they are incurred. But how are we going to know? How are we going to identify whether a transaction has been incurred? In other words, how are we going to identify whether revenue has been earned or not, and how are we going to identify whether expenses have been incurred or not. To understand that, we should have a very clear understanding, or we should now very clearly define these items. We should very clearly define income, expenses, assets, liabilities, and equity. And that's what we are going to cover in this lecture. So now we know we should be preparing our financial statements under the accruals basis. But what do financial statements prepared under the accruals basis show? Financial statements prepared under the accruals basis show users past transactions involving cash and also obligations to pay cash in the future and resources which are quite a tricky definition, but not that difficult. It basically means that our financial statements should show all the transactions, whether or not cash has been received or not, or whether or not cash has been paid or not. In other words, our financial statements should represent both cash and credit transactions. This is what the accruals basis show. What is the underlying assumption to be used in preparing financial statements? That's an area where most students get some difficulty to answer. What is the underlying assumption to be used in preparing financial statements? Many students would have, by mistake, answered that maybe it's the accruals basis. But no, that's not the correct answer here. According to our syllabus, going concern is the underlying assumption in preparing financial statements. Definitely not the accruals basis. The accruals basis is only a method of preparing financial statements. But the underlying assumption that we use in preparing those financial statements is the going concern. And of course, what does going concern mean? An entity is normally viewed as a going concern, that is, as continuing in operation for the foreseeable future. It is assumed that the entity has neither the intention nor the necessity of liquidation or of curtailing materially the scale of its operations. Very simple definition. So it is assumed under going concern that the entity will continue to operate. It is in no danger of closing down or of cutting a major part of its operations. And when such conditions exist, it means that the entity should prepare its financial statements under the accruals basis. But what if the entity has the intention or necessity of liquidation or of curtailing materially the scale of its operations? Like, for example, it's going through huge losses and it has decided that it can no longer operate. So what should it do then when it has the necessity of curtailing materially the scale of its operations? Well, if it did, then the financial statements will be prepared on a very different basis, which should be disclosed in the financial report. We shall consider all the bases later on in our lectures. More about financial statements. We all know that financial statements are prepared under the provision of IAS 1. course, you do not have to remember the IS name or the IS number, but of course, the principles, the application has to be very well memorized. So, what are the requirements of IS-1? IS-1 stipulates that financial statements should present fairly the financial position, the financial performance, and cash flows of an entity. Fair presentation requires the faithful representation of the effects of transactions, other events, and conditions in accordance with the definitions and recognition criteria for assets, liabilities, income, expenses set out in the conceptual framework. What we mean here is that given that we represent assets, liabilities, income, and expenses in our financial statements, we should represent them in the most truthful and faithful manner. Now, to get a very fair representation of these elements of the financial statements, then I guess we should have a very, very clear understanding of their definition, of how we should represent these items, or how we should recognize an asset as being one, a liability, how does it qualify the definitions of a liability, etc., etc. So, in this lecture, we'll have a very clear technical definition of assets, liabilities, equity, income, and expenses. As we shall see, the definitions will be much more technical, not like the one we have studied, we have memorized in our previous studies. We just said in our previous question that according to IS-1, we should achieve a fair presentation of the financial effects of our transactions. Now, according to IS-1, what is required for a fair presentation? We got three things to consider here. Number one, an appropriate selection and application of accounting policies. Number two, presentation of information in a manner which provides relevant, reliable, comparable, and understandable information. And number three, additional disclosures where required. Fair presentation is achieved when you conform to these three criteria. We cannot prepare our financial statements in any way we want. There should be a proper set of accounting policies to consider, and we should present the information in a very understandable, comparable, reliable, and relevant manner. And of course, where additional disclosures are required, they must be very clearly stated. When we started the lecture, we had mentioned that users take economic decisions based on the financial statements that they are reading. Now, what type of economic decisions might financial statements be used to make? Of course, the list is not exhaustive. Well, we could be taking decisions to buy, hold, or sell equity investments. These are the shareholders or investors to take these decisions. Again, the shareholders could need those information for an assessment of management stewardship and accountability. Management has been given the responsibility to run the business, so therefore they are accountable to the shareholders. Shareholders would want to know how well management has performed its duties of stewardship. Employees would like to assess the entity's ability to pay their salaries, and of course they are concerned with their job security, with promotion prospects, etc. Banks and lenders of finance are concerned with the assessment of the security of amounts that they have lent to the entity. They must be sure that the entity would be able to repay the capital amount, and a continuous payment of interest is expected from the entity. The government needs information for the determination of taxation policies, the macroeconomic policies of the economy. Even the management needs information for the determination of distributable profits and dividends to the shareholders. Again, the government would need information for inclusion in national income statistics, and also government would need information for regulating the activities of the entities, like issues such as pollution or the contribution of the economy to the economy by the entity in terms of provision of employment, etc., etc. And of course, the list is not exhaustive. Each and every user has his own information needs. Hence, let us consider the information needs of some of the users of financial statements. We start with the investors, who are the providers of risk capital. Firstly, they need information to help make decisions about buying or selling shares or taking up a rights issue and voting. Secondly, investors must have information about the level of dividend, past, present, and future, and any changes in share price. Thirdly, investors will also need to know whether the management has been running the company efficiently. And number four, as well as the position indicated by the statement of profit and loss and the comprehensive income, the statement of financial position, and the earnings per share (EPS). Investors will want to know about the liquidity position of the company's future prospects, and how the company's shares compare with those of its competitors. Investors won't be reading the financial statements of just one company. They would be making valid comparisons between the financial statements of various organizations, and that would help make them more sensible decisions. Or even, our investors could be comparing information about the same entity over previous years to judge whether there has been considerable progress in the activities of the entity. And as a result, they can expect a more dividend or not. Employees need information about the security of employment and future prospects for jobs in the company, and to help with collective pay bargaining. But most of the time, the employees won't be relying on the financial statements for such information. In fact, they won't even be reading the financial statements most of the time. Given that they are they are within the organization, they don't need the financial statements to judge whether they can help bargain, uh, collective pay bargaining, or they can be sure about the security of their employment. But still, there are potential users of financial information. Lenders of finance need information to help them decide whether to lend to a company. They will also need to check that the value of any security remains adequate, that interest repayments are secure, and that cash is available for redemption at the appropriate time, and that any financial restrictions, such as maximum debt equity ratios, have not been breached. Suppliers of goods for resale need to know whether the company will be a good customer and pay its debts. But once again, They won't be relying only on the financial statements for such decisions. At the same time, customers need to know whether the company will be able to continue producing and supplying goods and services. The government's interest in a company may be one of a creditor or even a customer. The company may be producing goods and services and supplying them to the government. At the same time, the government can be specifically concerned with compliance with tax and company law, with the entity's ability to pay tax and the general contribution of the company to the economy, for example, in terms of provision of employment to a certain section of the economy. The public. Now, the public at large would wish to have information for all the reasons mentioned previously. But it's also suggested that it would be impossible to provide general purpose accounting information specifically designed for the needs of the public. Like, for example, we know that the suppliers would be concerned about repayment conditions and all. But the public don't have any such specific information needs. Right, so we know now what are the information needs of each and every user so that they can take appropriate decisions based on those information. But then, what information do users of financial statements need exactly? We've got a set of financial statements to consider, and I don't think each and every user will be considering the same element on which to base their decisions. So there should be some specific elements that based on which the users would take their decisions. So what are those information? So the users of financial statements would need information about the economic resources of the entity. In other words, we are talking about assets here. Secondly, users would need information about the claims against the entity. In other words, the liabilities of the entity. And thirdly, users will need information about changes in the entity's economic resources and claims. In other words, changes in the assets and liabilities position of the entity. And all these information are provided by the financial statements produced by the entity. And then, how do information about the entity's economic resources and the claims against it helps our users take decisions? Information about the entity's economic resources and the claims against it helps users to assess the entity's liquidity and solvency and its likely needs for additional financing. Information about a reporting entity's financial performance, that is, the changes in its economic resources and claims, helps users to understand the return that the entity has produced on its economic resources. That's an indicator of how efficiently and effectively management has used the resources of the entity and is helpful in predicting future returns. In our syllabus, we are much more concerned with financial results of profit-seeking entities. Investors or shareholders would invest their capital in these entities to obtain a return on this capital. In other words, dividends. Now, unless the entity has given a very good performance, over the using the economic resources of the entity, the investors cannot expect to be obtaining a very good or appropriate return on those investments. So therefore, Investors should monitor the activities, the performance of the entity through those financial statements. And based on the information produced by those financial statements, they can make appropriate decisions. For example, if within a span of 2 years the investors concluded that the entity has not made considerable progress and as a result they cannot expect future dividend from this entity, they can decide to withdraw their capital and invest it in other profit-making or much more profitable entities. Hence, users rely on the information produced by the financial statements to take meaningful decisions. Of course, so that they can take meaningful decisions, the information should be useful. And useful information should have some qualitative characteristics. What does this mean? The conceptual framework states that qualitative characteristics are the attributes that make financial information useful to users. If the information is not useful to the users, they cannot use it to take decisions. According to our syllabus, useful financial statements should have two qualitative characteristics as per the conceptual framework. What are these two qualitative characteristics? The conceptual framework distinguishes between two characteristics, the fundamental qualitative characteristics and enhancing qualitative characteristics for analysis purposes. Let's start by defining the fundamental qualitative characteristics of useful financial information. Fundamental qualitative characteristics distinguish useful financial reporting information from information that is not useful or which is misleading. So we need to consider whether the information is useful to us for decision making or is not useful or rather misleading. That's the fundamental qualitative characteristics. And according to our syllabus, we have two fundamental qualitative characteristics to consider. What are these? The two fundamental qualitative characteristics are relevance and faithful representation. And what does relevance mean? Relevant information is capable of making a difference in the decisions made by the users. Of course, the decision should be relevant to me so that I can make an appropriate decision based on that information. For example, you're a student of financial reporting. You're about to sit for examinations for the financial reporting module. So what relevant information do you need so that you can sit for your exams? Well, of course, you need study text, your study notes on the financial reporting module. That's relevant information to you. But what if I give you study notes for taxation? Is that relevant? Of course, it's not relevant information for you so that you can sit for your examination. Same thing for investors, for our users. They should have relevant information so that they can make appropriate decisions. It is capable of making a difference in decisions because it has predictive value. Predictive value means you can predict the future, you can forecast some of the results of the entity based on that information. It has confirmatory value. Confirmatory value is any value that confirms the existence or the occurrence of a certain transaction, or in both. The relevance of information is affected by its nature and its materiality. A very important term used here is materiality. What do we mean by materiality? Information is material if omitting it or misstating it could influence the decisions that the users make on the basis of financial information about a specific reporting entity. Sometimes materiality may depend on the value of the item or the importance of the item to the user of that information. So this is our first fundamental qualitative characteristic, relevance. Our second fundamental qualitative characteristic, faithful representation. What does it mean? Financial reports represent economic phenomena, in other words, transactions, in words and numbers. To be useful, financial information must not only represent a phenomena but must faithfully represent the phenomena that it purports to represent. In other words, if the transaction has been that of a credit sale, the way we presented that information should be very much clear to the user that here we are depicting a credit sale. To be a faithful representation, information must be complete, must be neutral, and must be free from error. A complete depiction includes all the information necessary for a user to understand the phenomenon being depicted, including all necessary descriptions and explanations. A neutral depiction is without bias in the selection or presentation of financial information. This means that information must not be manipulated in any way in order to influence the decisions of the users. Free from error means that there are no errors or omissions in the description of the phenomenon and no errors made in the process by which the financial information was produced. But that does not mean that the information is 100% accurate. Under financial reporting, information can never be 100% accurate. That's because most of the time we can be using estimates for values. For example, when you're calculating the provision for doubtful debts, it's based on an estimate. You can never be sure about your provision for doubtful debts. So it does not mean that no inaccuracies can arise, particularly where estimates have to be used. But of course, there should be a very, very low degree of error so that you can base your information, your decisions on that information. Now, we shall see that most of the time we would be mentioning about the substance over form concept. Is that another qualitative characteristic of useful information? The answer is no. It's not another qualitative characteristic of useful information according to the conceptual framework. Faithful representation of a transaction is only possible if it is accounted for according to its substance and economic reality. What does that mean? Here we are talking about the substance over legal form concept. A transaction can have two forms: the economic form, or the substance of the transaction, and the legal form. Let's take an example. You, as an individual, you have purchased a car under lease agreements. So, under the lease agreement, however, we should also understand that under the lease agreement, the person the individual has the possession of the car, even though he has some lease repayments to make. So this transaction has two aspects that we need to consider. Firstly, we have the legal aspect, which says that the individual has to complete his lease agreement, has to complete payments over a period of, let's say, 5 years, so that he becomes the legal owner of the vehicle. But the economic reality of the transaction is that the individual has complete control over the use of the vehicle, which means economically he is the owner of the vehicle. So, a very important question to consider here. Should the individual include this vehicle as an asset in his statement of financial position or not? The answer is yes, he should include it, because we should consider the economic substance, the economic reality of this transaction. And the economic reality is that the person is in possession of the vehicle, of the asset, he is using the asset, he has complete control over the. Hence, it's very important to be clear about this, that we need to always consider the economic reality of a transaction instead of its legal form for recording in our financial statements. Shall take a look at this later on in our lectures. And now, our second qualitative characteristic of useful financial information, enhancing qualitative characteristics. Let's define it now. Now, while fundamental characteristics was about to distinguish useful information from misleading information, enhancing qualitative characteristics are about distinguishing between more useful and less useful information. So you should first understand whether the information is useful or misleading. And once you have a set of information that are useful, you select among them which are more useful and which are less useful for decision making. And what are the enhancing qualitative characteristics of useful information to consider? First of all, we have comparability. Comparability is the qualitative characteristics that enable the users to identify and understand similarities and differences among items. Information about a reporting entity is more useful if it can be compared with similar information about other entities and with similar information about the same entity for another period or date. Hence, consistency is important. In other words, we knew about the consistency concept. So to compare information should be consistent in the books of account. The disclosure of accounting policies is particularly important here. Users must be able to distinguish between different accounting policies in order to be able to make a valid comparison of items in the accounts of entities. When an entity changes an accounting policy, the change should be applied retrospectively so that the results from one period to the next can still be usefully compared. However, you should note that comparability is not the same thing as uniformity. Of course, if you see that there are some loopholes, or you can amend your accounting policies, you can change your accounting policies in case you have found that they are inappropriate or they do not present a true and fair view of the performance of the organization. Of course, you should change them. But of course, so you should be giving a valid reason why you changed your accounting policies, and you should show should demonstrate how they give a better view, a fair view, a true and fair view of your financial results. So our first enhancing qualitative characteristics, comparability. Secondly, we have verifiability. Verifiability assures users that information faithfully represent the economic phenomena it purports to represent. It means that different and knowledgeable and independent observers could reach consensus that a particular depiction is a faithful representation. In other words, anyone who wants to verify the authenticity of the transaction could do so, maybe by taking a look at the source documents, at the source of the information. Our third enhancing qualitative characteristic, timeliness. Timeliness means having information available to decision makers in time to be capable of influencing their decisions. Generally, the older the information is, the less useful it is. For example, you have an examination sitting in December and I give you your study materials in November. It's too late for you to study now. The information that I have given you no more has the timeliness enhancing qualitative characteristic. It's too late for you to take a decision now. And our fourth enhancing qualitative characteristic, understandability. Classifying, characterizing, and presenting information clearly and concisely makes it understandable. So, for anyone to take appropriate decisions based on the information provided by the financial statements, the information should have two types of qualitative characteristics: the fundamental characteristics and enhancing qualitative characteristics. Only then would that individual, would that user be able to take meaningful decisions. When a user or an individual is taking a look at the financial statements, basically what he's trying to do is he's measuring the performance of the organization, of the entity, and based on that information. Hence, which elements help in measurement of a financial position in the statement of financial position? Well, all that it contains. The statement of financial position contains information about the assets, the liabilities, and the equity position of the entity. So these elements should help in the measurement of the financial position of the entity. Likewise, which element then help in the measurement of performance in the statement of profit or loss and the comprehensive income? Well, the statement of profit and loss is made up of income and expenses, and ultimately profit. So these are what measure the performance of the entity in the statement of profit and loss. In other words, our users need information about these elements. So let's take a look at each and every element of our financial statements. Let's start with the statement of financial position, and we'll start by defining an asset. Previously, we would have defined an asset as something that the business owns, but this definition is no more acceptable according to our syllabus. We should have a very much technical definition as provided by the conceptual framework. So according to our conceptual framework, an asset is defined as a resource controlled by an entity as a result of past events and from which future economic benefits are expected to flow to the entity. Now, this definition has three major criteria that we need to consider. First of all, the resource should be controlled by the entity, or else we cannot classify it as an asset. For example, if you have, for example, a motor vehicle, but you cannot control it. Let's say you have to use it according to the instructions provided by a third party. So it means you're not controlling that motor vehicle, and you cannot define it as an asset. Second aspect of it, it should have been acquired as a result of past events. A promise to purchase an asset in the future does not hold true for the definition of an asset. And you should expect some future economic benefits to flow to the entity. Now, the economic benefit can be in the form of cash or cash equivalents. Now, so that you can properly define an asset, these three criteria must be present in the definition, or else you cannot identify that element as an asset in your financial statement. Hence, if you're asked this question now, what is an asset, you can no more say that it is something that the business owns. Your definition now must be according to the conceptual framework for financial reporting as provided here. In our definition of asset here, we use the term economic benefit. Can we define future economic benefits? By future economic benefits, we refer to the potential to contribute directly or indirectly to the flow of cash and cash equivalents to the entity. The potential may be a predictive one, that is, one which is part of the operating activities of the entity. It may also take the form of convertibility into cash or cash equivalents, or a capability to reduce cash outflows, such as when an alternative manufacturing process lowers the cost of production. Basically, economic benefits relates to cash and cash equivalents, either an increase in your cash or cash equivalents, or a potential decrease in an outflow of cash, in an expense, maybe. We had mentioned earlier that an intention to purchase a non-current asset does not in itself meet the definition of an asset. Is this true or false? It is true. Transactions or events in the past should give rise to assets. Those expected to occur in the future do not in themselves give rise to assets. Moving on, let's define a liability. A liability is a present obligation of the entity, arising from past events, and the settlement of which should be expected to result in an outflow of an outflow from the entity of resources embodying economic benefits. Previously, we would have said that a liability is something that a business owes to external parties. That's no more valid. The criteria to be considered in this definition is that the liability should be a present obligation of the entity. A future commitment to enter into a loan agreement does not constitute a liability. It should arise from past events. The settlement of the liability should result in an outflow from the entity of resources. Like, for example, if you have a loan, of course in the future when you settle the loan there'll be an outflow of economic benefits, an outflow of cash or cash resources. And once again, so that the definition of a liability to hold true, it should contain all the criteria that we have underlined here. When we defined the term liability, we talked about a present obligation. What does an obligation mean? An obligation is a duty or responsibility to act or perform in a certain way. Obligations may be legally enforceable as a consequence of a binding contract or even a statutory requirement. Obligations also arise, however, from normal business practice, custom, and a desire to maintain a good business relations or to act in an equitable manner. Obligations most of the time relate to liabilities. And as we precised earlier, can a future commitment be considered as a liability? The answer is no. It's very important to distinguish between a present obligation and a future commitment. Management decision to purchase assets in the future does not in itself give rise to a present obligation. So that the definition of a liability to hold true, we should be talking about a present obligation. All of us, or mostly all of us, are familiar with the term provision. We have worked with topics such as provision for doubtful debts, provision for depreciation, or even provision for discount allowed. So is a provision a liability? Yes, a present obligation which satisfies the rest of the definition of a liability. However, here, the amount of the obligation is just an estimation. We do not have an exact value to attach to the obligation, to attach to the liability. And now our third element of our financial statements, let's define equity. Equity, the technical definition, is the residual interest in the assets of the entity after deducting all its liabilities. In other words, when we take net assets, we deduct our net liabilities. Whatever is left is our equity. It is often said that the value of equity depends on the entity's shares. Is that true? No. It's absolutely incorrect. The amount shown for equity depends only and only on the measurement of assets and liabilities. It's got nothing to do with the market value of the entity's share. The market value is an altogether different topic, and which is not included in our syllabus. So when we are talking about entity, it's only about the measurement of assets and liabilities. So now we know that assets, liabilities measure the position of the entity, of course in the statement of financial position. Now, whether an item satisfies any of the definitions of assets, of liabilities, and of equity will depend on the substance and economic reality of the transaction and not merely its legal form. Is that true or false? Well, it should be true, because we had very clearly precised earlier that we should always consider the economic reality of the transaction and not merely its legal form. Items which meet the definition of assets or liabilities, however, may still not be recognized in the financial statements. Why is this so? That's because they must also meet certain recognition criteria. So even though that the definition satisfies the elements present in the definition, we still cannot recognize, we still cannot include those items as assets or liabilities in our financial statement, because they need to meet certain recognition criteria. And what does recognition mean here? It's the process of incorporating in the statement of financial position or statement of profit and loss and other comprehensive income an item that meets the definition of an element and satisfies the following criteria for recognition. Hence, so that you can include, you can recognize an item as an asset or a liability in your statement of financial position. First of all, it should be probable that future economic benefit associated with the item will flow to or from the entity. When we say probable here, we could say that it should be more than 50% probable. Of course, we are talking about future economic benefits, so we cannot be 100% sure that there will be an inflow or outflow of economic benefit from the entity in terms of cash or cash equivalent. But here, so that you can include that element as an asset or liability in your statement of financial position, it should be more than 50% probable that any such economic benefit inflow or outflow will occur. And secondly, the item, the asset or the liability, should have a cost or value which can be measured with reliability. And as such, regard must be given to materiality. But in a situation where no reasonable estimate can be made, the item should not be recognized. Because as we said earlier, some items cannot be given an accurate value. Let's take, for example, the value of a liability. The value of a liability can be very well estimated or recognized using the agreement. Let's say, for example, it's a loan agreement. So you just can take a look at the agreement that you owe the bank $100,000. So the value is very exact here, and you can include it as a liability in your financial statement. But as we said earlier, a provision is a liability which does not have an exact value. It is based on an estimate. So therefore, even though we have an estimate here, but we can measure it with reliability, so we can include the provision in our financial statements as a liability. But where no reasonable estimate can be made, you should not recognize that item in your financial statements. In other words, you should not include it either as asset, neither as asset, nor as liability in our financial statement. However, its existence should be disclosed in the notes or explanatory material to the financial statements. You can't just leave it like that. You won't include the item in your financial statements, but you will mention its existence, you will disclose its existence in the notes to the financial statements. With reasons why you cannot include it in the financial statements. So let's take a look at some assets that, even though satisfy the definition of an asset, cannot still be recognized in the financial statements. The recognition criteria does not cover items which many businesses may regard as assets. For example, a skilled workforce is an undoubted asset, but the workers can leave at any time. So we have no certainty about the probability of future economic benefits. We cannot be more than 50% sure that they won't leave the company. A company may have come up with a new name for its product, which is greatly increasing its sales. But given that it did not buy the name does not have a cost or a value that can be reliably measured, so it cannot be recognized. But still, we have to disclose these elements in our notes to the financial statements. So as from now, you should be very, very, very careful when deciding whether you should recognize an element as an asset in your financial statements or not, based on the recognition criteria mentioned here. So we are done with what measures the financial purpose. So profit is used as a measure of performance, or as a basis for other measures as well. For example, earnings per share. And if we're talking about a profit, its measurement depends directly on the measurement of income and expenses. So you could also say that the measurement of income and expenses will give us an idea about the performance of the entity. And where are we going to measure the performance of the entity? Of course, in the statement of profit and loss or other comprehensive income. And just like we give technical definitions as per the conceptual framework for assets, liabilities, and equity, we'll give some more technical definitions for income and expenses as well. Starting with income, what is income? Income refers to increases in economic benefits during the accounting period in the form of inflows or enhancements of assets or decreases of liabilities, which as a result increase equity. Contributions from equity participants cannot be regarded as income. When we are talking about contributions from equity participants, we are talking about share issue, rights issue of shares, a bonus issue of shares. These cannot be recorded as income. Now, sometimes we use the terms revenue, we use the terms gains as income. Both are included in the definition of income, where revenue arises in the course of ordinary activities of an entity, while gains are simply increases in economic benefits. Gains could include those arising on the disposals of non-current assets, like the profit or loss on the disposal of non-current assets. And the definition of income also includes unrealized gains. It could be the revaluation of an asset or even the revaluation on marketable securities. On the other hand, the definition of expenses. Expenses refer to decreases in economic benefits during the accounting period in the form of outflows or depletions of assets or even incurrences of liabilities that result in decreases in equity. Distributions to equity participants cannot be termed as an expense. For example, payment of dividend to equity holders should never be considered an expense. As with income, the definition of expenses will also include losses as well as those expenses that arise in the course of the ordinary activities of an entity, where losses are defined as decreases in economic benefits, and losses will also include those arising on the disposal of non-current assets, like loss on disposal of non-current assets. And the definition of expenses will also include unrealized losses. For example, the fall in the value of an investment, or a decrease in the revaluation of an asset. It's also an unrealized loss. We were asked to measure the elements of the financial statements. But then, how can we measure the elements of the financial statements? There are various ways that we can measure the elements of the financial statements. All depend on the circumstances. If you remember, we mentioned about the going concern concept, where we said that it is assumed under the going concern concept that the business, the entity, will continue to operate indefinitely. But what if it has the necessity or the intention to close down? Then we said that the business, the entity, must value its assets and liabilities under a different basis. So here, we'll mention those bases under which we can measure the elements of the financial statements depending on the circumstances. A number of different measurement bases are used in financial statements, and they include historical cost, current cost, realizable or settlement value, and the present value of future cash flows. We'll take a look at each one of them in detail later on. And when we say that we have to measure the items in the financial statements, what do we mean by that? What do we mean by measurement? Now, the process of determining the monetary amounts at which the elements of financial statements are to be recognized and carried in the statement of financial position and the statement of profit and loss and other comprehensive income. But as I said, all depends on the circumstances on how we are going to measure them. At historical cost, at a realizable value, etc. So according to our list of how we could measure the elements of our financial statements, on number one we had historical cost. What does historical cost mean? It means that assets are recorded at the amount of cash or cash equivalents paid, or the fair value of the consideration given to acquire them at the time of their acquisition. Liabilities likewise are recorded at the amount of proceeds received in exchange for the obligation, or in some circumstances, for example income taxes, at the amount of cash or cash equivalents expected to be paid to satisfy the liability in the normal course of business. Historical cost is the most commonly adopted measurement basis, but it can be combined with other bases. Like for example, we have inventory, which is carried at the lower of cost or net realizable value. We'll consider these measurement bases in much more detail later on. Here, we'll just define them. Second measurement of base of measurement, current cost. What does it mean? Assets are carried at the amount of cash or cash equivalents that would have to be paid if the same or an equivalent asset was acquired currently. Likewise, liabilities are carried at an undiscounted amount of cash or cash equivalents that would be required to settle the liability currently. Thirdly, we had the realizable settlement value. What does it mean? Realizable value is the amount of cash or cash equivalents that could currently be obtained by selling an asset in an orderly disposal. On the other hand, settlement value is the undiscounted amount of cash or cash equivalents expected to be paid to satisfy the liabilities in the normal course of business. So realizable value would be associated with an asset. Settlement value would be associated with a liability. And present value. What does it mean? Well, I suppose you must have heard about it in your previous studies in management accounting, more specifically in the chapter investment appraisal, where you calculated net present value. Well, that's the same thing here. So what does present value mean? It's a current estimate of the present discounted value of the future net cash flows in the normal course of the business. Once again, we are going to take a look at each one of them later on in much more detail. We also mentioned the term fair value. What does that mean? Now, recent standards use the concept of fair value, which is defined by IFRS 13 as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. For now, this definition should be enough for you. But later on, we'll give a much more elaborated definition of the fair value because we are going to use the fair value in certain calculations in our syllabus. Now, whatever we've seen till now, whatever we have covered in our lecture till now, was all about what has been prescribed by the conceptual framework for financial reporting. Like for example, we give a definitions, we give technical definitions of assets, liabilities, equity, income, and expenses as per the conceptual framework for financial reporting. But what exactly is the conceptual framework? What does it mean, the conceptual framework? So the conceptual framework in the field we're concerned with is a statement of generally accepted theoretical principles which form the frame of reference for financial reporting. These theoretical principles provide the basis for the development of new accounting standards and the evaluation of those already in existence. In other words, when we are talking about the conceptual framework, it is a set of guidelines which you're going to use to record transactions and to present them in the most faithful way in our financial statements. At the same time, these guidelines, these theoretical principles, so we could use them as a basis to develop new accounting standards and to evaluate those already in existence. Therefore, a conceptual framework will form the theoretical basis for determining which events should be accounted for, how they should be measured, and how they should be communicated to the user. Like for example, the conceptual framework, the principles, the theoretical principles of the conceptual framework will help us identify whether we should recognize an element as an asset in our financial statements or not, how we should measure that asset, and how that information is to be communicated to the user of our financial statements. Like I said earlier, this is what our syllabus is about. Our syllabus is not only about consolidation of accounts. Our syllabus is about the recognition and the presentation of all the elements of the financial statements. And based on this exercise, of this preliminary exercise of recognizing our elements of financial statements, this will help us in the consolidation of our financial statements in the last chapters of our syllabus. So we are talking about the conceptual framework for financial reporting, and then what is the financial reporting process concerned with? The financial reporting process is concerned with providing information that is useful in the business and economic decision-making process. How is the information going to be useful? We already saw that according to the qualitative characteristics of useful financial information, the attributes. We have fundamental characteristics, we have enhancing qualitative characteristics. We know what exactly is the conceptual framework, a set of theoretical principles. But what does it state exactly? Or what is the objective of the conceptual framework? Now, the objective of the general purpose financial reporting is to provide information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. And what exactly are the purposes of the conceptual framework of the set of theoretical principles? We got various. First of all, it helps to assist the board in the development of future IFRSs and its review of the existing IFRSs. The conceptual framework, secondly, assists the board in promoting harmonization of regulations, accounting standards, and procedures relating to the presentation of financial statements by providing a basis for reducing the number of alternative accounting treatments permitted by IFRS. We would be confused if a single transaction or a single event can be presented using a various number of ways. Each country or each accountant, maybe, would use his own way and say, okay, but it still presents a faithful representation of the transactions. So the conceptual framework provides a way of harmonizing, of standardizing these methods so that we could reduce the number of ways of presenting our financial information. Fourth, to assist national standard setting bodies in developing national standards. Number five, the conceptual framework assists preparers of financial statements in applying the IFRSs and in dealing with topics that have yet to form the subject of an IFRS. Next, the conceptual framework assists auditors in forming an opinion as to whether financial statements comply with IFRSs. Auditors are required to provide an opinion on the financial statements, so they have to refer to the provisions of the conceptual framework. Next, the conceptual framework assists users of financial statements in interpreting the information contained in financial statements prepared in compliance with IFRSs. Most of the time, users of financial statements may be unaware, may not be too familiar with the jargon used in the financial statements. So they can use the provisions, the conceptual framework as a reference from which they can derive definitions, they can derive methods using which the information has been prepared and presented. And finally, the conceptual framework can be used to provide those who are interested in the work of the IASB with information about its approach to the formulation of IFRS. We'll talk about the role of the IASB in our next lecture. And what exactly does the conceptual framework deal with? The conceptual framework is interested in the objective of the financial statements, which we know already is to provide useful qualitative information to existing and potential users. Also, it deals with the qualitative characteristics that determine the usefulness of information in financial statements. The qualitative attributes of faithful representation, relevance, comparability, understandability, timeliness, and relevance. The conceptual framework provides all the guidance regarding the definition, recognition, and measurement of the elements from which financial statements are constructed. It helps us identify whether we can recognize an element as an asset, as a liability, or as an equity element in our financial statements. And finally, the conceptual framework is concerned with the concepts of capital and capital maintenance. Now, capital and capital maintenance is an entire chapter, an entire lecture altogether. We'll take a look at it in our later lectures. Now, is it safe of not having a conceptual framework? Or, let's say, what is the danger of not having a conceptual framework, a frame of reference? Well, the danger of not having a conceptual framework is demonstrated in the way some countries' standards have been developed over recent years. Standards tend to be developed in a haphazard and firefighting approach. The lack of a conceptual framework also means that the fundamental principles are tackled more than once in different standards, thereby producing contradictions and inconsistencies in basic concepts such as those of prudence and matching, thereby leading to ambiguity, and it affects the true and fair concept of financial reporting. And the problem with the lack of a conceptual framework has become apparent in the USA. The large number of highly detailed standards produced by the Financial Accounting Standards Board, the FASB, has created a financial reporting environment governed by specific rules rather than general principles. This would be avoided if a cohesive set of principles were in place. It's better to have principles rather than strict rules. Strict rules means that you have to follow them irrespective of whether they give a true and fair view of the financial state information. If you have a cohesive set of principles, then you can question any type of standard set, which can then be amended using the reasonings. We'll talk about the conceptual framework, the rules, the general principles of the conceptual framework later on. We've seen that the conceptual framework helps national standard setting bodies to develop national standards. But what is the role exactly of national standard setting body? Now, where an agreed framework exists, the standard setting body acts as an architect or designer, rather than a firefighter, building accounting rules on the foundation of sound, agreed basic principles. What do we mean by firefighter here is that the standard setting body would not act only in circumstances where the principles or the guidance are being subject of a certain interrogation, or let's say where the standards are being questioned. No, they will rather amend those standards based on agreed basic principles, and not only act when there's some question being asked. So we've understood the dangers of not having a conceptual framework, but how about the benefits of having a conceptual framework? The situation is avoided whereby standards are developed on a patchwork basis, where a particular accounting problem is recognized as having emerged, and resources were then channeled into standardizing accounting practice in that area, without regard to whether that particular issue was necessarily the most important issue remaining at the time without standardization. Secondly, the development of certain standards, particularly national standards, has been subjected to considerable political interference from interested parties, where there's a conflict of interest between user groups on which policies to choose. Policies deriving from a conceptual framework will be less open to criticism than the standard setter buckled to external pressure. And thirdly, some standards may concentrate on profit or loss, while some may concentrate on the valuation of net assets in the statement of financial position. And now, how about the drawbacks now of having a conceptual framework? Financial statements are intended for a variety of users: lenders, investors, employees, the government, etc. It is not certain that a single conceptual framework can be devised which will suit all users. That's because all users will have different information needs. And the role of the conceptual framework is to standardize policies and procedures. So we cannot really devise a single conceptual framework which will suit the needs of all users. Secondly, given the diversity of user requirements, there may be a need of a variety of accounting standards, each produced for a different purpose and with different concepts as a basis. But it's not really possible to do so. It's not really clear that a conceptual framework makes the task of preparing and then implementing standards any easier than without a framework. That's because at any time you can question the provisions of a standard, which then has to be amended. GAAP. Well, we have frequently heard about this term, generally accepted accounting practice. But what does it mean exactly? GAAP signifies all the rules from whatever source which govern accounting. In individual countries, the GAAP is seen primarily as a combination of the following: the national company law, national accounting standards, local stock exchange requirements, the international accounting standards (IASs), and statutory requirements in other countries. National company law, national accounting standards, and local exchange requirements are mandatory rules. You have to follow them. On the other hand, international accounting standards and statutory requirements in other countries are not really mandatory. You can be selective here. Now, the IASB wishes to narrow differences in practices in individual countries by harmonizing all aspects of the financial statements, including the regulations governing the accounting standards and the preparation of and presentation. In other words, the IASB wishes to reduce the alternative number of accounting treatments that may exist. Now, list such differences. Now, each country has its own social, political, economic, or legal variation, but the result in variations in practice from country to country, including the form of statements and the definition of the component parts. Each country may have a definition for asset, liabilities, etc. So the criteria for recognition of items and the scope and disclosure of financial statements should be harmonized. We cannot allow it that, let's say for example, Egypt has its own definition for assets while the UK has its own definition. A user who is trying to compare the financial statements of a firm in Egypt and another firm in the UK will have difficulty in comparing the information. In other words, he is not comparing like information because Egypt has a different definition for assets while the UK has a different definition. So he won't be able to take meaningful decisions based on that information. So the IASB will wish to narrow such differences, such variations. The conceptual framework recognizes that financial statements can be prepared using a variety of models. Is that true or false? That's true. Because in the rare cases of conflict between an IFRS and the conceptual framework, we need to consider what will happen to it. So therefore, yes, we can prepare our financial statements using a variety of models. Finally, the conceptual framework is not an IFRS and does not overrule any other individual IFRS. Is that true or false? That's true. The conceptual framework is not an IFRS. And in case, which is a very rare possibility, there's a conflict between an IFRS and the conceptual framework, the IFRS will always prevail. So that's the end of our lecture, which was based on the conceptual framework, which was now, if you wish, you may purchase the practice questions kit from our website. Just go to studybuddy.trainingonline.eu, click on the registration button, fill in your names, your details, your email address, etc. Well, the registration is free, you got nothing to pay for that. Once you have registered, you shall receive a mail from training at studybuddy.trainingonline.eu. You must check your inbox as well as your junk box or your spam mail. It may go into those folders as well. You will receive a link which will ask you to set up your password. Just click on that, open the link, set your password, and when you're done with setting your password, you may log in using the username that you have inserted here. That will be your username. You can select any username you want and the password you have set up. Once you have logged in, you can then go to the eShop and purchase any practice question sets that you want. They are at very affordable rates. You can practice those questions at any time you want. How many times you want, you can practice those questions, and they are available. They will be always available on your dashboard. So I wish you all the best and see you for the next lecture.